Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, March 4th, 2024. It's 12:29 p.m. as I'm starting the video, so we're about halfway through the trading day, and quite a bit I want to go over. As I often hope, it won't be a super long video, but I want to wrap it all up into one, and that way, just piecemealed out. I'll tell you how I'm going to cover it. That way, if you want to skip ahead to something, I'll start out with, as we're looking at here, gold. I want to go over the trade ideas. I usually tend to start out with the equity markets, and from some of the comments on the site, you'd think that's all I ever post. So maybe there was a handful of very vocal voices on there on the comments section lately. Don't watch to the end of the videos. That's where I often will get to the additional, all the other trade ideas, the things I'm trading. So I'm going to put those in the front now, and more so, I usually try to prioritize what I'm covering based on what's actionable or stands out the most on any given day. So what I bring up today is this breakout in gold. This is a new high in gold in GLD, the gold ETF. This was our previous bull market all the way back here in gold. Let me grab a circle tool. 1 second. There it is. And that ended in a blow off top, and we had a bear market in gold that ended in the end of 2015, and then it was a pretty much basing pattern here, and we broke out. That was a big level to me back then, 130, and that was a measured target right there for the basing pattern. You take the width of the basing pattern, we hit that, and then that turned out to be that little line there. Unless that was a double top measure, I'm sorry, that line I believe was the measured target on the base, but it's also, you have this other period of consolidation. That's what happens when you get these double or triple top patterns, or a range down below. You can take the distance of it, add it to where it breaks down if the pattern breaks down below. Likewise, you can do that with these basing patterns and add that to where it breaks out to give you a measured target. But most importantly, that was all then, this is now, is this breakout today. We still have significant negative divergences. And as I often say, but doesn't fall on everyone's ears, divergence is not a buy or sell signal. It's just an indication momentum's been waning. You can see we're in a strong bull trend, and we've been moving sideways for a while. But this is a breakout, and we'll see where it goes. Obviously, and this is another thing really that's very important. I talk on every day, but it's time to time some don't get it. Long-term, big picture stuff, where something is going, whether it's a market or gold or anything else, is kind of, hey, this is where things look like based on fundamental analysis and technical analysis, where they're likely to go over the next couple of years. But I've never positioned for anything since I can remember that was more than a holding period of usually 6 months or more. Even if I'm trading that trend, like gold, most trades have been alongside and been bullish since off those lows right there. We went long there. We went long again here. We shorted, got out at the highs both times when we put those up there. Right now, as you know, for the last week or so especially, but even going back for the last couple of months, we've been catching silver. I'm going to get to that in a second, and highlighting multiple entries at the bottom of the trading range. And then just last week, I've started pumping the miners. Really liking a lot of especially the silver miners, but the gold miners as well. And so my point being that, okay, this is a divergent high, could fail. And here's what we do. We watch out for a failure. If we get a failed breakout down and we start then going down through support levels, which I'm going to get to in this video, then the breakout has failed, and that could have longer term bearish repercussions. As of now, I'm not trading off the weekly charts or position. This is a 60-minute chart. Here's gold. There's a breakout. Everybody's buying it today. Volume's big, and that's it. Breakout is a breakout until less fails. That's one of my many yogi-isms that I've made up over the years. And that's it. So if it fails, it fails. It's not unusual to see a breakout back tested, and even then, it's just as normal to see a back test come slightly below to kind of blow out some of the stops on it and then reverse. But a solid move back down into the range, and especially below it, is going to be net bearish. But there it is. There's your gold. Again, on this 60-minute chart, we don't have any divergences or anything like that right now. Yeah, we're overbought, but that doesn't stop securities in a bull trend. Gold, again, you define your trend. Long term, as I just showed you on the weekly chart when I started out, it's been a sideways market in gold for the last couple of years. But near term, we're off the October lows. It's been in an uptrend, and we're at new highs now. We'll acknowledge it looks a lot like the stock market, and maybe it's going to continue to trade that way. And so let me get to the 60-minute charts. And again, that's the best way to navigate both gold, and then I'll get to the equity markets, I promise. And by the way, if I spend too much time on the trade ideas, I will truncate the video and then do a separate one exclusively on the equity markets, because I definitely want to get to a couple things there. All right, so that's it. And we look at silver, SLV, silver ETF, still plenty of room to catch up if it wants to. This is my busy board, I call it. But most importantly, you've got this uptrend line off the lows that silver's been walking up. And then the trades again, the trades that have been laid out many times recently. It's a 60-minute chart. This is, if I could only pick one time frame to trade, even, as an investor, but particularly a swing trader, this would be it. Now, fortunately, I can look at multiple time frames, and that's what I do. And I'm never taking my eye off the daily or the weekly charts, even if I'm focusing all these videos and the charts I get out to you, if I'm using a lot of 60-minute charts. Pointed out, this has been a very nice support level, about $20 on silver. We had that one whipsaw through there, but we've had especially the most recent reaction lows have all been there. And so I've highlighted each of these recently as long trade ideas. We had targets, so an active trader. Again, this is what swing trading is about. Get in, make 5-6%, get out or turn around and short it, make another 4 or 5 down, swing it up. But here we go. We're starting to step higher now. This is the important thing, is that now, at least in the near term, this is all the making. This is a near-term uptrend in a intermediate term sideways trend, right, with silver. But if it wants to follow gold, gold's breaking out. If that breakout sticks, and silver has a lot of catching up to do. And so, as it often, not always, but often is, it's my preferred trading proxy for the metals, on silver futures. Sometimes I'll overlay, sometimes I'll trade both. Sometimes I'll even favor gold based on both the technicals, and if I think it's going to be a flight to safety bid, money moving into gold, which you sometimes see. And then silver, silver's just more volatile. I always say it's, kind of like trading the 30-year bond instead of the 10-year bond. You're going to get the call right or wrong, and if you get the call right on where the metals are going, you usually get paid better on trading silver, whether it's long or short, depending on what call you're making. But that's it, guys. I just wanted to point out, boom, 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 boom. And so, nothing goes straight up. We're at one of a resistance / target zone now. And maybe we'll get the early makings of an uptrend line here. If we get another pullback to help validate it. And if not, then I can tell you, just like I've been saying for months now, if not weeks at least, $20 is big support that you don't want to see to get taken out on silver. And if the breakout in gold fails and the sellers step in, that's possible. But as of now, like I said this morning when I got the updates out to you, and that was in the video last week when I started highlighting the metals, focusing mainly on the silver miners, but then I followed up with a chart of GDX with targets, and this is GDX. What did I do? I must have gave it a daily chart. Yeah, it was a beautiful little downtrend line, and again, support. That's the biggest thing. Just like silver, which I just showed you, multiple pullbacks to the support level. And the only thing I like better going long than going long at support is going long at support with positive divergences, which is what you had. You had it on silver, you had it on GDX, etc. And so, boom. And we're in early and before the breakout. You hit first target last on Friday. You hit the second target today. This is swing trading, and you're going to have most likely a reaction here. That's why I list multiple targets. So far we had a brief momentum fueled overshoot on both of them. When you see these big green candles and they're going straight up, that's, again, another term I've made up, momentum fueled overshoot. You have a lot of tremendous upward velocity or momentum, you're going to tend to overshoot a resistance level and then sling back. And you parked on it that day, and that was it. A 1 day reaction, closed right on it. Or right today, same thing, punched through it, but it is resistance, and so you get certain bouts of profit taking, but still looks good. And as I often say, depending on your trading plan, where you entered, consider if you either one of two things there. You either book partial or full profits, and or meaning and if you book partial profits, it would be an and. Then you also raise stops. There's no reason to turn a quick winning trade that's up just 10% in a couple days to let that turn into a loser. At very worst, set stops to break even and let it run. One thing I can promise you about the metals and the miners is that they're volatile. And so there's going to be days where the profit taking is pretty strong. And the way it works is, if you did book profits or if you miss this altogether, then you look for objective pullbacks to support. If we happen to pull back, top of the gap on the daily would be the first support, then the bottom of the gap, and then T1, which is just below that. Anything else? Yeah, probably wouldn't want to add. I want to see a pullback get bought up. I think that'd be pretty healthy. And then just so 10%, you're like, oh, wow, that one's gone. That's par for the course. This is how GDX moves. And then SIL, Silver Miner ETF, was highlighted last week right here off this nice 2250-ish support. And boom, first target hit for about a 9% gain, followed by the typical reaction. So far, you can see the reaction on the 1 minute chart kind of stalling out here. And if the metals continue to power on up, then these are the next targets. There's still targets there, and that's that. So you're up to speed on the metals and miners. And silver future traders, this is, again, level that I had on the chart from way back here, last breakout or last, there's been so many entries on silver. Same thing, we can go back even longer, but you can just see you've got really a couple, this is the lowest support level. This is comparable to that level on silver that we've been tapping on. And these were all targets laid out, and boom, you hit that 20. It's about $24 right there. Several reactions right there to find that level, and so that's what an active trader can do: is profits and then recycle back in on a pullback or sit tight. You don't have any negative divergence right now on silver, so I at this point in time, anything's possible. But I suspect the pullbacks will get bought up, and we'll probably get some more upside in the coming days to weeks, and it could just go up like this, if everybody starts buying that breakout on gold. I don't know, but like I said this morning, I think charts are still constructive. Ditto for natural gas. Throw that one out there recently, and this is was here. I used the futures and UNG, gave you targets, but as I said a couple weeks ago, if you trade UNG and you don't use futures, you can't, you miss entries sometimes. It gapped above T1, but I've been highlighting this one, lately and reiterating that I still like it. And it's got an uptrend line, and that's a potential stop point, if it takes out the trend line. And so for all intents and purposes, we've hit this. Remember, these price targets, and I rounded off. I told you the other day, everybody loves round numbers, so I just rounded it up to the nearest round number. And I always say, so it's $18 at T220 there. And just for fun, if I extend it to this target, it's actually a little bit above 27. But again, on UNG, the charts get sort of distorted or diluted over time because of the expenses and the role they have. I prefer futures, and I don't work for the CME. I'm not promoting futures for anybody. If you don't know what they're, learn. There's plenty. You go to CBOE or CME, and their websites have educational information on how to trade them, how they work. If the contract size is too big, just about every major commodity or the indexes have mini and micro versions. It's MINY for the minis, and micro is, as the name sounds. I think it's QG, if I remember right, for natural gas. This is NG, and the thing is, the same price level. So even if you depending on your account size, you might not want to go with the if if one contract NG puts you too much exposure, then you can use the I think it's micro mini. I know it's QG, I believe, if I'm not mistaken, but you want to look that up, and it should trade at the same levels. They just have a smaller multiplier, just like on the NQs that I trade, the Nasdaq 100 futures. You have MNQ, and I think it might even be another version, but they just same price level, same chart. They just have a lower multiplier, which is the leverage factor in there. And so this one, you can see it keeps walking up. I've been pointing out the divergences, but I also point out the divergences aren't a sell signal. And then I've been pointing out, where are the objective levels to either buy pullbacks. Last time I highlighted right there. So if you bought that pullback on that gas futures, you're up 16% just from the pullback. If you bought the breakout where I first posted it, and this is still part of that trade, then you are up about 22% in just a few weeks. A lot more than the market's going up or anything else out there that's that I've been posting short setups on. Okay, so I've made it clear in the last few weeks that I'm personally not taking USO, natural gas, trading that long, but USO more watching at this point in time for really, share. Anything I post analysis. Your job is to take what you like and incorporate it into your trading. So you may have been long natural gas. Crude oil, but I wanted to point out where we've taken out. And I think I did point out on Friday, we took out that key levels about 74 on USO. Again, that's where all the recent reaction highs have been. And we've been pop resistance. We popped it on Friday. We're currently back testing it. Now, as I mentioned, we've had divergence building. That divergence is still in place by the skin of its teeth, meaning if we go up much more, it won't be there. It's not the be all end all. Just then, it will, in my opinion, sharply diminish the odds of this breakout failing. In other words, Friday was the breakout. Today is a back test. TA 101 says you can buy a back test. It's objective. A back test of resistance once broken then becomes support. And we're at 74.10 right now. My level, you can see the lines at 74.08, so close enough. Again, I'm watching it. And one of the things I'm watching it for is, what will it do to the Fed's, what will it do to inflation, real or perceived, and how ultimately that might affect what the Fed's going to do. Because make no mistake about it, I know I've said this repeatedly, and it just, to me, bears repeating. I cannot recall in the last decade or more, really since the financial crisis, such a dichotomy between the economic indicators. And I look at leading indicators, not coincident indicators. Leading indicators and what the stock market's doing. And I can see that. You saw it last week. It was, ISM, I think, on Thursday. I'm going from memory. Big miss. It's still in contractionary territory. Contractionary doesn't necessarily mean recessionary, but it is anything below 50. So you keep coming in low. And I've got a lot of these indicators that are mimicking pre-recessionary trends. They're again, the leading indicators, the ones that are important. And so, but what you're seeing, and you saw it, I think it was Thursday, it might have been Friday, you're seeing almost the opposite effect, that when you're seeing finally, when we got a spike in unemployment claims, and the market is actually treating that as good news, even though it's bad news fundamentally for the economy, because it'll increase the odds that the Fed's going to cut. And so again, it's like a heroin patient that will do anything for the juice. And I promise you, once the economy turns, I've used the analogy like a super tanker, it's hard to reverse. So you're going to see, and we've seen that. And I promise you, if I'm correct on where the economy is going, and these economic indicators continue to show the trend reversal, from an expansionary to a contractionary environment, then the longer that divergence happens, where the stock market holds up or goes up with the economy turning, the bigger the mean reversion. And there will come a point where all of a sudden, despite what the Fed does, bad news will be taken as bad news. It always has, and it always will be at some point. as I like to say in other yogiism, it doesn't matter until it matters. So we'll see there. But again, that's fundamental stuff. But why am I talking about it now? I'm not going on a crazy tangent here. This is the number one thing that we can watch tick by tick, second by second, that has the biggest impact. The only thing that housing market, you don't have any indicators that trade on an exchange daily and go up and down and, second by second prices. You got to wait for lagging and often revised data and all that. So crude oil, again, big impact. And like I said, it's more so something to watch than a prediction of where it's going right now. But if I had to lay odds, I'm going to say odds. As long as that breakout holds, odds favor additional upside in crude prices, and that will, to a greater or lesser extent, sooner or later handcuff the Fed and what they can do and just how much they can cut this year. And I think it was also last week or the week before, recently I laid out, I think it's time to get back into a broad-based commodity ETF. Looks like a little W bottoming pattern there. You get this W pattern. Oops, that's not my line tool. That is some similar there. And basically, I'm going to put a line here that should do the trick if we take it out. I can see some resistance right about 2260, and what I'm looking at here, it was support. We had a brief whipsaw down below it, acting as support in this area here. It was support again. They rallied off it, but then it broke. Once it broke, boom, 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 boom. These are rejections. Support once broken becomes resistance. So now the way it works is resistance once broken then becomes support. So this was a downtrend line that was a resistance that popped today. This has been support. You can see support is held. It's about 2250 or so. And so this would be your next natural target if you're short-term swinging it. And if you're looking for a longer-term play in the commodities arena, that would be it. As I've mentioned often, these broad-based commodity tracking ETFs are they're top. It's just due to the way the broad-based commodity indexes are. They're top-heavy in energy. And that's because energy is the biggest. If you factor through the economy, if gas goes up 50%, that hurts Americans a lot more than wheat going up 50% or orange juice futures. So that's why it's the big one. It's the one to watch, and you can see in here. But you're covered. It's so easy, like I say, a one size fits all for everybody. If I make your head spin when I'm talking 1 minute about crypto and the next minute about penny biotech stock and then treasury bonds all in the same video and sometimes in the same breath, you want to keep it simple. Here's one ETF. It's kind of like a mutual fund, but better, in my opinion. Lower fees, more liquidity, and you've got it all. You've got gas, crude oil, West Texas Intermediate, Brent crude, New York Harbor, natural gas, precious, gold, silver, and then your ag commodities, about a quarter in ag commodities. I haven't updated this in a while. That was, last end of July last year. But bottom line is base metals are, those are your industrial metals, about almost 13%. Ag commodities, sugar, corn, soybeans, that kind of stuff, 12% precious metals, and then about 50% in energy. And so two things. If this goes up, that's the arena of commodities. And if this goes up, and I'm right, which I suspect it will, not to mention the divergent low and everything I covered in the video last week, as we've been basing here, pop that level, and this is where the market should start to take note. A lot like I gave you the yellow and orange zones for treasury bonds recently, which we'll get to in a second. This right now, markets, this has been 110%, if you will, other than, maybe not 100. I know you used the extra 10 to throw in a little bit of being a little silly there. But obviously there's been a tremendous amount of fiscal stimulus from the government, monetary stimulus. We're running the biggest peacetime deficits in the history of our country. The only time GDP to debt, our GDP to debt ratio has been so high as in wartime previously. And so all that good stuff. So they've still been juicing the economy ever since COVID. They just never let the foot off the accelerator. And Fed started to a little bit, and then we had 2022, of course, then tried to take it back. But where I'm going is we will see the return to both inflation, talks of it, real or perceived, but really real. If these are commodities, these go up. You could offset that with a drop in the housing market. We'll see. All I'm trying to do is point out the technical levels and to watch. And also, this is a trade idea in itself as well. And it's a way, most importantly, and again, I say this till I'm blue in the face, and I know there's either just a handful of folks on the site that only trade the stock market, and then and they're very bullish. I don't know why you're here. If you're only trading the stock market, go join a bull blog. You'll in a bull market, you'll do a lot better. But I try to impress the point, the benefit of diversification, how it's every bit as important in swing and active trading as it is in long-term trading or investing. So if you're putting everything you have into Apple or SPY or QQQ, yeah, you're either going to have a good day, a good month, a good year, or a very bad day, a bad month, or a bad year. You put a little bit into the markets, you put a little bit into when the charts are bullish or bearish, natural gas, gold, silver, the mining stocks, crypto, bonds, different sectors in the market, and of course, different individual stocks. If you do that appropriately and you're aware of which of those different assets have positive or no or inverse correlations. That's part of it too. Talk about you can't, I've got 10 stocks in my portfolio. I'm diversified. Well, if you've got Microsoft, Amazon, Apple, and Nvidia, you're not diversified. You're in the same thing. You're in the heaviest trade in the market. That it's a highly correlated one at that. All right, let me move on here. You get the point. There's a lot of other stuff out there, and we've been doing very well on natural gas and the metals and the miners lately. And next week maybe something else we'll find. Let me talk on that. When I'm on trade ideas, I mentioned on Friday, since we got in CARA early enough that I was going to take it home and keep it on, and reiterated my targets before they reported this morning. Earnings are out of the way, and the day I posted the trade setup, which was to be taken on a breakout above 83 and the downtrend line, I followed up in the comment section, said, look, you're probably going to hiccup around the $1 area. That's even though I didn't have it initially on the chart as resistance, that is usually a resistance level for any stock that was not a penny stock, but then recently fell below the $1 level. And that's it. And you can see we've been consolidating since. We hit it that day. Again, a momentum fueled overshoot. The day of the breakout had a big gain, well into the double digits. Couldn't park it at the close above there. And so we've consolidated in here. So now earnings are out of the way. We don't have to worry about that. It's still a biotech. Got to worry about that. What I mean, let me digress for a second here. It's probably the only, I can tell you offhand, it's the only sector, and I've talked about this for years, that is you have to be careful with, more careful than any other one. Any other sector out there that I know of, all you have to be aware of is when they report. They report quarterly earnings, that is, and it's published ahead of time. You know exactly when they're going to report, the exact day, and you know exactly if it's going to be in the morning or after the close, or some companies report during hours, but that's rare. With biotechs, not only do you have to navigate earnings, which is predict, you can tell when they're coming. If you're risk averse, get out before they report, or hedge up, or do something, or lighten up. But the problem with biotechs, especially smaller ones, is they have drugs in their pipeline often, and it could be in various stages. And out of the blue, you can have an approval, or the FDA stops trials because of adverse events, meaning people getting sick or dying. And those come out of the blue. The FDA usually doesn't tell you, hey, we're going to announce that. So I just want to throw that out there with biotechs. And that dovetails into the other comment that somebody made on the site. Let me see if I can dig that one up. Okay, it was from, I guess this is Friday's post. There's too many comments to get to. Most of them are just comments on the market's going to the moon and the video's going to the moon, that kind of stuff, not really useful takeaway stuff. I tried to answer any questions that put to me. Somebody asked about what happened to stocks. I updated stocks. The last update was just last week in this video, and clearly, see, I'll get to that in 1 second. You can see in the video, it's actually right here. Yeah, it was the 27th. And I, talked on the weekly chart. We've got this weekly uptrend lines, same now on the daily. You got to take that out. And then it's hard to see in here, but even on that chart, and I've had it since December 14th. And this kind of speaks to the market calls too, which I'll get to probably in the next video, if not this one. But said looking back on December 14th, and I'm maintaining, I've been looking for about a 52% drop to the 271-ish target over the next 1 to 2 years. Okay, so that is a long-term outlook, and a lot like the stock market, where I still haven't maintained longer-term targets, but have been extremely clear on what needs to happen. Going back to last fall, and then in the same comment thread that I was just on, somebody else asked or made a comment about, oh, the purple lines are way below. We keep getting farther from your support levels. Yes, absolutely, we get farther. Because those purple lines, again, when I get to the indexes, I'll cover those a little more in detail, are exactly what needs to be taken out. Let me just jump back to CARA, are exactly what needs to be taken out and needed to at that time back last fall, was it October, November. And not only did they not get taken out, but I said there were key supports. We had divergence covering all shorts going long. So it's like, let me think of an analogy. So it's like, okay, I'm from Miami originally. My team's the Dolphins. So it's like me saying next year I predict the Miami Dolphins are going to win the Super Bowl if they can win the AFC Championship. All right, that's a conditional thing. So if they start out the year and they're with a losing record and they don't even make the playoffs, I'm not going to bet the Dolphins to win the Super Bowl. And I'm not a sports bettor. Don't bet on sports, never have. But if I were to, I would wait until the championship game is won. They win the AFC Championship, and then they're going to go to the Super Bowl. And at that point in time, I would lay my bet. I would look, and I would have the odds. They're going to be near 50-50. One team will be favored or the other. It's the same exact thing on the stock market. So I can talk about where I think it's going, but I'm not going to sit there short where I think the market will be within 1 to 2 years, or long for that matter. So please understand that, guys. Every day I go over the levels and watch little things, and it's constantly evolving, dynamic. So back to CARA. Looks good. That's it. That's all I can say. We've taken out $1. If we close above $1, that's a big to me, and I think it'll open the door to my targets. And then on that, let me go back to the post I was just on. That was right here. Sorry, that was the first post there about the semis, and I wanted to get to that. Okay, Randy, does a penny stock like CARA move the needle in anyone's account? Using proper position sizes, you'd put it most like 5% in what you might put in an index trade. Okay, wherever you got that number, that's fine, C6. Your number is your number. I went so far in this one to be very clear in the setup, which you can click on and go to, that when I put it out there before it even broke out, pre-breakout, that suggested beta adjusted position size. In other words, what I would do is 0.35, and I, in the here, let me go here, resources. You can see on the FAQ, if you don't know what I'm talking about, here it is. What is trading related questions? Where is it? What is beta adjusted position size? And so I go on, and came up with that term way back when, how I use it, how it works, and very clear. I encourage you to read up on that. It's very simple. And then to take it a step further, I came up with a calculator I made years back, and that's it. So typical position size. This is the example I actually give in that reply. So here's a beta adjustment of 0.35, which is 1/3 of what you would take, and you compare. A beta of 1.0 is the stock market, really the S&P 500. That's what most institution, everything is considered. Market beta of 1 equal to the S&P 500, a diversified index, and I even use that example here. So in that case, again, your number may be 1,000, and that's why I don't, whoever was, maybe that's your number that you usually put. But in this case, it's a long trade, and you enter that. You can plug it all in here, and it'll tell you how much to put in, how much you're going to lose, make. But I did the math without even using this calculator. Let me just go back to that, because I believe this is important to share. Okay, so makes sense if you want to, YOLO and your last 500 bucks into something. You only live once. And say, okay, blah, blah, blah. I don't think that had anything to do with that. Okay, so my reply, probably the same person, thumbs down. I can't tell you how much to put into a trade or what to trade for that matter, but I clearly suggested a beta adjusted position size of 0.35 when it was posted. That means about a third of what one might put into the broad market, like SPY. If CARA hits my final target from where I post, where the entry price was, again, we posted in advance, so no one would miss it, triggered after the setup, that's a gain of 200%. So therefore, and again, you can use, I use 100,000 as a round number. If your number is 10,000, if it's 1,000, or if it's 1,000,000, you can just multiply. If that trader would normally put 100,000 into a swing trade on SPY, if they took just 35,000 a CARA, their profit would be 7,000. That same trader would need to make 70% on a swing trade on SPY to make the same amount of profit. In other words, you put 100,000 in SPY to make $7,000. Okay, that's obviously a typo, and my everything's right here. I just left out the zero. So if you put 35,000 in CARA and you make 200% profit, gain of 200%, you're going to make $70,000, or twice what you originally put in. The same trader would need to make 70% on a swing trade on SPY to make the same amount of profit. Let me go on from there. There's no way of knowing if the trade will pan out, but if it does, I would expect it will only take several weeks to a couple of months. So when was the last time anyone ever made 70% or even 20%, on SPY in that same time frame? The 20% is here. So I went on to say, even if CARA only hits my first target, assuming it does hit it, but if that's all it does and that's it, and you take profits there or raise your stops below it and then you get stopped out with a tight stop, you made 58%, which again is a 20% equivalent gain. Basically you take 58%, multiply it by 0.35, and you're going to get a 20% gain on SPY. So, and again, even then, when was the last time you made 20% on the S&P 500 in just a matter of weeks or months? Again, maybe it pans out, maybe it doesn't pan out. But to me, I have to address this because, it's, if you put 500 bucks in there, let me just say this too. If you only have, if 500 is your number, you probably shouldn't be trading, maybe paper trading. Again, if it fits your thing, and it might be worth someone at $500. Even if you had a lot more capital and you could afford to put a lot more in there, and you hit that final target and you make 200% return, well, you took 500 bucks, you made $1,000 on it. I think that's pretty much worth it for most people. I don't know. And again, another thing, and I'll just add to this and then we'll move on. I always talk about there's two, really at the core, two factors of components I looked into a trade. I look at the RR, my risk to reward ratio, how much I'm targeting. And again, in percentage terms or dollar, because I beta adjust, that's kind of relative. The ones with the bigger percentage profit potential it also have the biggest loss potential in percentage gains. But then I take my dollar amount down to offset it. In other words, I don't care. Percentages are irrelevant to me. It's how much am I going to win or lose on a trade dollar-wise. That's the important thing, because everyone has their number. You can afford to lose X amount on a series of trades without getting wiped out. And so that's where it's at. So that's where the whole beta adjusting comes in. But then the other thing I was going to say, it's pretty much almost a fixed rule. And I've talked about this a lot in the past. The trades that I post that have the higher gain loss potential, like a CARA of the world, they tend to have a lower probability of success. Meaning, if I'm trading just SPY or QQQ, it's got a higher probability on a swing trade or an active trade of playing out. It's more predictable with the charts. You don't have, like I said, with CARA, the risk of a drug in the pipeline getting shot down by the FDA. But that above average gain loss potential, even if the success rate of the trade is lower, the chance of success, that's offset by the above average return. It kind of washes out. So you can sit there and trade a steady eddy all day, like SPY, the S&P 500, or Treasury bonds, and you're going to have a lower, usually a less favorable RR. And by the way, with a 200%, that's the other thing, guys, I'm trying to get to here. If your upside return on this trade, the minimum, if my first target is hit, what was it? 70%? No, 58% on the first target to 200% to my max target, T3. T1, 58. So on that, you also don't have, I wouldn't use a 3-to-1 RR. I wouldn't risk 50% or more, 70% if targeting T3. So you tend to have more favorable RRs on those less trades that I call lower probability trades that might have a lower probability of playing out. And so therefore, I might use like a 5-to-1 RR on those trades. And at the end of the day, if I didn't think it would work out, I wouldn't take it. There are trades I'd post, trade ideas, and I said, look, I'm not taking this one. Apple was a great example last week, and I made it very clear. Hey, it looks objective to me. I know there's a lot of foaming at the mouth bulls out there right now. Here's Apple at the 200-day moving average and great price support. If you're bullish on Apple and you're bullish on the market, there's your shot. Now, I said, I'm not taking it because I think the level will fail. And I'm going to get to that when I cover the broad market. Let me just make sure I've covered everything else. So I'm going to talk on SMCI real quick because that one I posted back. Somebody shared that. That one was back here. Where was it? Yeah, this was on, March 4th. And I didn't even know what SMCI was. So I took a short on it. I told you then, and I went to update it, put it as official trade idea. And today it's punched through the previous high. Now I happen to be, call it lucky or dumb, to short it right at the highs there on March 4th, or right off the highs. And so now I do want to say as an update, the bearish engulfing candlestick has been taken out. So as far as that being a potential topping stick, I mean, this could be it and we go down, but you can't make that case anymore because we just cut through the top of that. However, for me, I give you a sole price target. It's my price target. Get the 200-day moving averages and that 355.60 level right there. I'm planning to cover just above it. And that from where I shorted that day was right here, 371, right about there. That's a 60, almost a 70% drop if hit. So on this, I can easily and will give myself, I'm just using manual stops on this right now, mental stops, And at this point in time, from where I shorted, I'm down a whopping 5. And it's rare. I told you I covered NVIDIA, swung it down, but right before they reported. This thing's just tracking NVIDIA. But on this one, I decided to tuck that one away and sit patiently. So I just wanted to mention that. Now, would I short it today? No. My trading plan hasn't changed, so I took it where I took it. I'm going to stick to that. If it starts getting anywhere near, a 3-to-1 or even a 4-to-1 RR, depending on what's going on in the market. But again, there's a lot of inputs that go into my trading, and I'm going to get to that in the next video. I'm going to cover the broad markets because now we're at the 42-minute mark. And when I do, what I'm going to be covering is what I threw out to you today, probably the most important thing in the stock market. I covered the breakout in gold. That's pretty significant today, new multi-year highs. But this was Apple. Again, I got a chart out to you this morning because it's one of the things I'm watching. You remember we broke that level and closed below it on Friday. You can see that little candle there. Not by much. Again, I always say if you have to squint, give it the benefit of the doubt. But it was a breakdown. It was down pretty deeply intraday. They rallied it back up. Remember, support, once broken, becomes resistance. Our support level, and it was a very good one, was 180. That's why it was colored up yellow. 200-day exponential moving average, 200 simple. So in one fell swoop, we took out the 180 and the 200-day exponential, the lower of the 200-day moving averages. And we don't have to squint now. We're clearly below there. Does that guarantee Apple's going to go down more? No. Does it significantly increase the odds that it will, and it's objective short, and that it's going to go down, and then most likely bring the market down with it? Because I don't care. other than these frequent updates, one of the last big updates I gave is, here we go again, kind of just joking around the kiss of death, the $3 trillion again, every time Apple seems to hit. And these other companies are doing it too. You'll see it with Microsoft and NVIDIA. Here it is, my $3 trillion kiss of death. And I covered this chart in the past. Hit the 1 trillion mark. It's just these round numbers that they bring out the cheerleading squad on CNBC, pom-poms and up in the air jumping, and then it's almost a kiss of death. It's a buying climax. We hit 1 trillion, the stock lost a third of its value just 5 months later. That was the first time you hit a trillion. It was the first company to join the $1 trillion club. Became the first $2 trillion company, and then lost 15% off that day. The day it made that high, a month later, was 15% lower. In January 3rd, it crossed the $3 trillion mark for the first time, and from there it lost a third of its value over the next year. Highlighted again here on June 30th, 2023, it became the first publicly traded company to close above $3 trillion. Remember, this was an couldn't even hold it intraday, kiss of death. Closed above it, and I called for and still expect from that point a 30 to 50% drop. And we hit it again here. It just surged again. First time since August. It tried to take it out again. So it's like a ceiling, if you will. And either way, take it for what it's worth. Microsoft's going to see the same thing, I would imagine, NVIDIA, and all those that have joined that $3 trillion club. But I guess one of the takeaways is, first of all, we're going to look like almost certainly we're going to close below that level on a daily closing basis, which is a start. And again, odds are real time. It's just like that thing I predict if the Dolphins are going to win the Super Bowl next year. The odds are going to change from game one, even heading into the season with injuries and all this, and then as the season progresses. And so the odds on all this stuff are fluid. The odds will increase even more that we're going to go down when my purple lines are taken out, and if we close solidly below 180 in the 200-day moving averages on a weekly closing basis. Okay, and then the odds go up even more, and that's Apple. It would be very, very, very unusual to see Apple drop another double digits and the QQQ holds up or continues up. I've seen it one other point in recent history over the past 2 decades. I remember when Apple had a 40-something% drop and the market kind of held up, but that is more the exception than the rule. So again, I'll cover this in the next update. I have some economic indicators I want to cover, some key market leading stocks. In this video, I covered the trade ideas. That's most of what I wanted to get to. And then I'll do the update, a little bit deeper dive with some economic indicators and a couple other stocks that I'm watching right now for both potential trading vehicles as well as kind of a cue on what to look for with the stock market. This has been Randy Finney with Right Side of the Chart. Have a great day.